Welcome back to the channel. I'm Foreman. In this video, I'm going to be talking about Boohoo's big shareholder breach. I'm also going to be talking about the UK stocks I'm buying now and market commentary on Greggs, Primark, Ocado, Unilever, Watches of Switzerland Group, and also Games Workshop. So if you like the video, please drop one of these to help beat that YouTube algorithm, as it is much appreciated. So yet again, this week my portfolio has, annoyingly, a large segment of my video wasn't actually recording audio. So my whole portfolio update part of this hasn't been recorded. So unsurprisingly, this week my portfolio has underperformed the markets yet again. I'm down 5.32%. In stark contrast to the UK markets, which are up 1.15% each respectively, and the American markets that are down ever so slightly. My portfolio as a strategy is certainly not preserving wealth. However, I built this portfolio so that it may outperform over the longer term periods that I plan to be invested in. When I say longer term, I'm talking 20, 30, even maybe more years. I plan to be invested in the stock markets until I drop dead, and hopefully that isn't by a random bust and at a very soon moment, but the point still stands. I'm not here to make a quick profit so that then I can live day to day and perhaps replace my working income. I'm trying to use my working income and my career earnings to therefore invest money into the market so that then I won't have to, or I have the freedom in the future to go, you know what, actually I don't like where I'm currently employed. I'm just saying this out of randomness, for example, and therefore, I feel that, you know what, I have the money, I can go and do what I want. Maybe I want to be a barista in a cafe, but at least then I know that my investments are paying for my day-to-day bills. And that is why my strategy at the moment, I'm not concerned that it's down by 41.27% in 676 days. That, yes, is a red flag. You might go, okay, what's gone wrong with the strategy, and you'd want to review it. I've reviewed the strategy and I've realized that actually market sentiment in the stocks that I hold, due to the fact that I hold a very exposed, lack of diversification portfolio, means that in the short term, at the moment, these stocks aren't seen as strong. And so during an inflationary pressured environment where obviously these stocks aren't seen as strong due to the fact that they have limited earnings compared to perhaps other companies that have huge amounts of cash flow, they therefore have been priced down. There's also disruptions to the supply chain. I'm talking Boohoo, I'm talking Games Workshop, where it takes a lot longer for delivery times to be met, and therefore these stocks are seen as less favorable in the current market climate. I believe, however, that these stocks will do very well over the longer term, and it is only a matter of patience. I know that I am very early in my career. I will be working and earning a consistent income for a much longer period of time than I have lived for, and therefore I can use this knowledge to therefore say, right, I can up the risk to reward ratio, not because I'm actively seeking out risk for no apparent reason, but because I know that I can recover this money fairly quickly through earned income, instead of saying, well, actually I have 7 figures in my portfolio, I don't earn 7 figures a year, and therefore being down, let's say 400,000 is a much greater problem. I'm not looking to preserve my wealth at this stage of the game. Instead, I'm looking to grow it as sustainably but rapidly as possible by investing in companies with minimal debt and good cash flow. And obviously these businesses do not have that strong cash flow at the moment due to the fact of the market environment in which that the industry-wide pressures mean that these companies as a whole are struggling. It just means that over time this should hopefully reflect this. And I don't expect to outperform in bad markets, so let's say bear markets, whereas perhaps Berkshire Hathaway is well positioned to perform well in downtrending markets, but they're not as well positioned to do well in upwards markets. I feel that I'm the opposite of this direction. My stocks are very much very high volatility. When things go south, they're going to go south by a much larger margin. Therefore, that is why I'm underperforming the likes of a lot of these indexes by quite a significant margin, simply because I am therefore overexposed to individual positions, and therefore, as I say, when the markets go down, these usually go down by a greater amount. However, I anticipate that over time these stocks will climb a lot further, and therefore my risk to reward ratio pays off. I've also added a little thing to my spreadsheet, as you can see on the screen, in which I've added a pivot table on Google Sheets. This tells me when I first made a transaction with a specific company, and then when I've made the latest transaction with that company. I've not narrowed it down to whether I've bought more or when I sold, but you can assume for any company that isn't Games Workshop or Boohoo that I've sold the lot, aside from in my SIP, but my SIP isn't tracked, I can't talk, in this portfolio spreadsheet. We can see that actually, for instance, a lot of my holdings like National Grid, Royal Dutch Shell, Unilever, Legal and General, Diageo, Rio Tinto, they were all sold a similar time around to when I bought Boohoo. So I get a lot of questions, which was July, going, well, why did you sell these stocks? They've done so well, you've made a mistake. In reality, I've bought a company that I think is far greater, but obviously it's going to take time for these fruits to bear. And so I need to sit here, be patient, consistently deposit money into the markets, and therefore see my reward or my actions pay off over the longer term. So far, the story with my companies has not changed. It is only a market environment that has changed. Therefore, I'm willing to continue buying them. And I think Boohoo in particular is very well weathered for recessions. So when we jump into the news of the week, we can see that Jupiter Star Fund has hit the investment cap breach. And obviously, I do understand that this is a little bit cropped off to the side, but Jupiter was the largest shareholder of Boohoo, and they were a £3 billion fund run by Richard Watts, who you can see on the left of the two images right here. And effectively, during the 2 months of spring in 2020, their position size of Boohoo took up a total assets under management of greater than 10%, which the FCA, or the Financial Conduct Authority, have a rule saying that if it goes over 10%, you need to obviously fix this position size. As you can see here, under FCA rules, funds that exceed concentration limits should be put right as soon as reasonably practical, and at the very most within 6 months. So at this point, Boohoo shares had rallied very much, quite significantly actually, and this had meant that obviously their assets under management had increased a lot, and they were holding 14.74% of Boohoo in the fund in May 2020. Now, they were the largest shareholder, and things have subsequently gone downhill. Boohoo is down something like 70% in the last year alone, and when they reached those highs in May 2020, Boohoo was trading at around about £4.40 per share, which would mean, obviously, when we're looking at the total or the current share price of Boohoo being roughly 92 pence as of this video, that is nearly 5 times lower. That is a significant change in obviously the shares of this. And honestly, I suppose in this way, they had two options here, where this breach could have been great for the people invested in the fund if Boohoo had continued to outperform, but they didn't. And because they didn't, it made them look like they are absolutely greedy money managers that really don't care anything about the fees and obviously their own profits. And this is a concern really when investing in funds, because you don't know what their motives are. Obviously, they had noticed that one of their best holdings had continued to outperform, and so it had gone above 10%, and obviously that's a great sign. And in that way, I agree. If I have a stock that's doing well, I'm not going to trim my winners and water the weeds, for instance. If you know what I mean, you're not going to trim your plants and water the weeds, because it's just not a wise strategy. But in some way, shape or form, perhaps in this mind, you would be taking a little bit of profits if you felt the shares were being a little bit frothy, but then in no way could you forecast the decline that they had over the next year and a half as of recording right now. But it is one thing to mention that obviously Boohoo has had this big shareholder breach where actually they were untrustworthy in this regard, held over 10%, and now subsequently they have reduced their stake in the business from around about 10% to 4.7% as of their recent holding declaration. But this is likely due to their total assets under management falling. Because people are selling out of the fund, they therefore have less capital in to invest, and therefore they need to sell out in order to maintain position sizes and also apply to the FCA laws of keeping it under 10%. With that in mind, Greggs is also going to be competing a little bit with Boohoo with their new fashion range at Primark. Now, I always found this to be a little bit of a laugh. I don't know why that person's popped up on the screen, because Greggs have almost become quite a running joke, and not in a bad way for the business, but quite an interesting way at that, where perhaps their steak bakes or their vegan sausage rolls have gotten a bit more credibility online, where that they've become running jokes or memes per se. And I did find it quite amusing that apparently several shoppers had spotted fashion mannequins in a number of Primark stores holding Greggs sausage rolls and steak bakes in store displays. And to be fair, like, this is a very good way of marketing in my opinion, because hey, look, Greggs is already a well-known business, but when you've got two businesses that you wouldn't necessarily put together, it does obviously change things up a little bit, because you wouldn't expect to go into a Primark and see a steak bake. You're going to be like, what? Why is that there? Right, so which customer's gone into the store and messed around with the mannequins? Because, and it's quite an interesting proposition. I don't think the clothing will sell that well. I don't think it is deserving of a fashion range, but then you can never underestimate a running joke, like obviously the stocks like GameStop and these meme stocks such as AMC as well. Boohoo in a way have slightly competed with this as they've released their Disney pajamas in time for whatever type of day that is. I'm guessing it means Valentine's Day, but I don't know why there's a G in front of it. Not a clue. But I thought that was of interest too. Bearing in mind this week I have increased my Boohoo position size by normal or more than the average, and it is updated on my Patreon, link description down below. But I bought 258 shares of Boohoo at 96.57 pence on Monday the 7th of February, but I also had a limit buy order that I set just in case the shares have gone down. I think I set this at 92 pence, which actually or accidentally triggered on Wednesday the 9th of February at 87.84 pence per share, which made pretty much a fantastic value snipe in that way, where I did manage to get a good amount of shares at a low price. But again, it was only 143 more shares, but it does mean that my average price is tumbling. My total Boohoo holding size this week has actually increased to 11,273 shares. And then we've also got Games Workshop. Now, this is one I haven't been talking about that much as of late, but I do think there is some commentary to be made on this company. I do like the company, and I like how they do very much give me good diversification between Boohoo and itself. Boohoo being inferior goods. These are typically goods and products that do well in recessions. They are cheap products. As income decreases, therefore their products become more valuable, and therefore the total volume of these products they'll sell more, and they are well positioned to weather the upcoming recession, which is likely going to happen with the inflation figures and obviously the tightening of monetary policy by the Bank of England and possibly the Federal Reserve in the US. It would be weird if they don't follow the market in terms of rate hikes, but we will be interested to see how that one plays out. But inflation, obviously, people are going to reject these rising prices, spend less, and subsequently we are going to have periods of negative economic growth or economic decline, leading into a recession of over 2 subsequent quarters. But Games Workshop here are more of a premium product. I don't think if you can describe them as Veblen or is it Giffen, but they certainly are a product that is very, very sticky. The idea here is that, yes, they can combat inflation because they can rise prices by 10%, but the consumers are still going to buy them. And now they're looking to add range rotation to Warhammer 40k, Warhammer 40k being their biggest brand that they have, at least in the Warhammer universe. But obviously the Age of Sigmar is certainly a newer one, but starting to grow as well. I think this is actually huge as well, as they say here, because range rotation adds pressure to the consumer. They're saying effectively, look, we have so many different models and ranges that it's awkward for us as a business to supply them all at a given time. So what we're going to do is we're going to focus on a smaller amount. We're going to give them limited time offerings, so that then we're going to give you advance warning saying, hey, look, actually on February 2017, we're going to get rid of the Imperial Fists Captain. So if you want to get that, buy that now. This is a great way of getting rid of stock so that inventory doesn't build up to too high of a level, but also a very effective way of stimulating demand, because there might be uncertainty as to when these models come back. They may never come back, even though they have said that they would. And obviously these models are still legal in their gameplay. So it is certainly of interest to me. I think range rotation is a very clever business strategy, and one that I am very happy to be a shareholder of Games Workshop with. That in mind, I've not bought any more shares of Games Workshop as of late, but that is purely because I feel there's better value in my other positions, such as Boohoo. But Games Workshop are certainly on the radar for me, and I will be topping up this position once I feel that Boohoo has certainly seen a fair evaluation on their total assets and really the business itself. We've also got the Watches of Switzerland group, and now they have quite a few premium branded goods. Premium branded goods can do very well, as for instance, if you increase the price of these products, sometimes because they become such a rare sort of asset in a way, or they're seen as perhaps things that you buy that puts you in an exclusive club because they're such a scarce item. So rare watches such as Gucci, Rolexes, etc. can certainly hike prices very well in this regard. You can tell I've been studying my SEMA stuff and I'm really trying to apply it into here, and hopefully that is good. But if you don't like that, do let me know. But I do feel that I did struggle a little bit more on the whole economic side of things, and I'm feeling now that once I can start to catch up here, I can deliver more value to you on the channel. So if you do like that, please do click the subscribe button down below. But the Watches of Switzerland Group are a very, very high quality company. They've actually seen that their quarter three group revenue is 348.1 million, which is up from 272.6 million, or 27.9%. Now hopefully there's a table down here, but you can see absolutely phenomenal growth in the US at a constant currency year-over-year basis of 44.6%. Obviously, the US actual total revenue for quarter three is nearly half that of the UK, but the UK has also grown by about 20.1%. So their overall group revenue of the year-over-year statistics are up 27.9%, and I think this is a very promising amount. When we look actually at the year-to-date revenue performance, we can again see that year-to-date, year-over-year, is up 38% at a constant currency basis. Very, very strong growth. And I suppose a PE ratio of around about 40 times earnings is actually a reasonable spot, providing this company is able to maintain their strong earnings growth. But I feel that once obviously this growth slows down, declines, or just has a one-off trading update where there is perhaps worse than anticipated results, I do think shares in this kind of stock will decline quite savagely, and then that might be a good opportunity to be topping up on the investment and really making the most out of building a position. So certainly one on my watch list, although not one that I'm actively looking to buy at the moment, because I do think there are other deals and discounts in the markets that are available that perhaps have a greater cost at the current amount that will give a better return on investment. Dynam Group is another one of my holdings, and I will update you in a second. I do like this business as well. They retail homeware effectively, and they have it in their big warehouse superstores. Now, they've also had some pretty impressive growth. I mean, with Dunelm Group, you're not going to be expecting 40% year-over-year growth due to the nature of the business. But even then, they've had some fairly consistent but strong growth. Yes, the digital total sales has declined by 2 percentage points. That's fine. 33% of their sales being digital, though, is a good milestone, and providing it stays around about a third level, I think that is a very promising sign indeed. And because obviously the last 2 years have been quite exemplary in terms of pushing people into using digital total sales as the retail stores were shut, I do feel that this was artificially higher. And if it finds a good point to level off where it is ahead of where it was in the past, I think that is a great sign to see. Yes, their net cash has actually decreased by £93 million. Not a great sign, but they have also announced a special dividend of 37% very recently. And actually their their interim dividend had a growth of 16.7%, and I think that is a good steady amount of growth. Plus the special dividend, you're really getting a good yield on cost with this investment. Year over year, their total sales has increased by 10.6%. Again, I think that's quite strong, and their gross margin has actually increased in this time. But the main thing to be looking at here is their profit before tax increasing by 25.3%. And they've also given a little bit of trading to date, or the outlook in it, is that they've said that the winter sale has continued to be encouraging, and the board expects that the full year of 2022 for profit before tax will be in line with recently upgraded expectations, so a positive sign. And they've also said that macroeconomic outlook remains uncertain, inflation, disruption to the supply chains, but they've mentioned that, however, we are well placed to navigate inflationary challenges, effectively meaning that they're probably able to raise the prices of their products because obviously they are in this type of industry. Also, that perhaps the cost of products or perhaps the materials increasing may not be a direct problem for this company in particular, and therefore they are not going to be seeing as much pressure onto their business in that regard. I would need to do more research on this, and I think where is it? I think they had something quite promising where their free cash flow is up £8.3 million as well, and free cash flow is a promising sign because effectively that's the money the business makes without extra expenses on top. And so obviously they have a lot of capital available to them, and they can really do quite well. And I do believe that they actually don't have any debt on the balance sheet, but they do have access to a credit facility that is sustainability linked, which I don't think they've mentioned on here. Argo Blockchain has given their update, a company that I no longer hold. And actually, when we look at the spring so far, I've done quite well. But they've said that they have mined 172 Bitcoin or Bitcoin equivalent compared to 214 in December 2021, and that this reduction is due to an increase in network difficulty. We're now seeing their mining margins decline and decline. It's now 74% for the month of January, whereas in December it was 83%. And subsequently, this was higher in the past. It was 84, 85, 86. I speculated in the past that perhaps they were shutting off their machines during certain times where network difficulty was high, so they were able to artificially sustain higher than anticipated mining margins on their Bitcoin. But ultimately, I did decide to sell this investment because I lack understanding in this. Yes, Bitcoin could go up rapidly, it could go down rapidly, but my investment strategy needs to be sustainable. I need to understand why a company is going to grow in the future in order to invest in it. Argo Blockchain themselves did have good fundamentals, but I didn't know where Bitcoin would go up or down, so therefore I felt I was going to be uncertain in volatile markets and took a 50% loss on this, even knowing that perhaps in the future it could well recover, but I wanted my money elsewhere. That, and they're going to be burning a lot of cash over time. Yes, they're making money, but at the same time, they're not necessarily what they got to do in order to make money is they've got to increase their capital expenditure or capex, and in order to do that, when they don't want to sell their 2,748 Bitcoin, is that they're going to be taking out more debt or diluting shareholders. A bad sign for the shareholders of the company, a great sign for the executives, so that their pay can increase alongside growth of revenue by using these sort of metrics. So again, not one that I keep up with, but I still follow so that I can keep my perspective and perhaps mindset on Bitcoin available to you guys, but also routinely remind you as to why I had sold out of this position. But then we can see, maybe in a year's time, I would be wrong to sell out. But again, I think that my logic stands in my strategy, where selling out of Argo Blockchain was the wise move for me when in this portfolio changes. That sentence didn't make sense, but I hope you did understand it. Ocado has had their final results for the full year. They've mentioned a retail growth of their revenue of 4.6%. Their group revenue has increased by 7.2%, but the UK solutions and logistics has increased by 8.6%, suggesting that perhaps over time, once their retail part of their revenue becomes a smaller portion of the business, that they're actually going to be able to grow their solutions and logistics and their international solutions at a much faster pace, being a promising sign for the business, suggesting that whilst at the moment, yes, you'd be buying it for their retail aspect, but over time you'd be buying it for their technology that is used in warehouses like Kroger in the US, for example, where they use this in order to distribute product more effectively for online deliveries. And I think they may use it for a few other reasons, but I don't follow Ocado too closely. Their earnings before interest, taxes, depreciation and amortization with retail is actually 150.4 million. However, their overall loss through their international solutions is 120 million. So actually, overall, their group EBITDA is 61 million. But then obviously, once we go further than this, they've got a loss before tax of 176.9 million, and they've had a very high amount of capital expenditure, and obviously they now have more debt than cash on the balance sheet, but that is likely just a change that is required by more obviously expenditure to grow their international solutions part of the business. Again, this one is a little bit out of my understanding. It's not something I necessarily follow too closely, but I do regard it as a quality business. But again, they were holding up a very high valuation, and I think that's what you really had to question, because they have halved in the last year in terms of their share price. But before then, they had a phenomenal run-up of something like 400%, and it very much became a hyped-up item. They're not profitable, but they do have cash flow. This business isn't going away anytime soon. It's a question of whether they're able to continue to keep their unique selling point, and there isn't competitors in the space that are able to do the same job, but more effectively. But I have a feeling this is going to be a very sticky business, and with the licenses and patenting that they have, providing they don't lose a certain court case against their other one, I think they could be this could be a business with a very large moat in the longer term future. Unilever has also had their full year results for the business. Their underlying sales growth is 4.5%. Their turnover is 3.4%. Their net profit is increased by 9%, but their free cash flow has certainly increased by quite a substantial margin, going from negative 1.3 billion or euros to now 6.4 billion euros. Again, this is a stalwart. This is a company that they're a very defensive position. They're a very mature company. This company therefore rewards shareholders in the form of dividends, because reinvesting that money back into the business, or a large majority of that money, is not going to add much value to shareholders, because this business has a low amount of growth potential. But what they can do is they can streamline the business, as they are doing by selling their tea business for 4.5 billion euros, and really therefore give it back to shareholders by share buybacks and also dividends. But again, the dividend per share growth of 3% for 2021 is quite on the low side. So yes, whilst at the moment you've got a yield on cost or something with a dividend of about 3 to 4%, overall I don't think it's that promising of a sign. And I think I'd really be looking elsewhere for companies with a little bit more growth potential. But I can't actually remember the share price. If I have a little look at Unilever's share price, we might be able to see a little bit more. They're trading at £38 per share, which in the last year, actually the last few years, has been trading sideways, but a dividend yield of 3.81%. But if you'd been looking in hindsight, I don't know what the dividend yield was at the time, you'd be collecting dividends, but you wouldn't necessarily be outperforming much, if at all anything, because this is a defensive investment and one that is likely going to be quite slow indeed. If you're interested in how to improve your credit scores, then click the card at the top right of the video. Thank you for watching. I'm Foreman. Have a fantastic week.